Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi, I'm Tanushree Banerjee, Co-Head of Research at Equity Master. Electric vehicles are not a necessity for every Indian. There aren't pure-play EV producers in India that have been around for decades. Profits for EV makers in India are still hard to come by. And blindly buying the stocks of the biggest EV makers in India could be like driving without the rear view mirror. Electric vehicles are not just disruptors. The entire ecosystem is new, and therefore selecting the best EV stocks is easier said than done. Instead of scampering to be part of the EV gold rush, you need to carefully observe who is making the real money. So, get this right. The traditional approach of stock selection may not work for electric vehicle stocks. Not only because the elements needed for the traditional approach are missing, but also because this is a sector that will see massive technological and regulatory evolution in the years to come. So, what is the approach you should take? Remember the recent Zomato IPO? The reason I'm referring to Zomato is because, like electric vehicles, this is a business that's a disruptor in the new ecosystem. The scope of growth is untested, and there's very little comparison possible with the traditional companies. The key reasons why investors were upbeat about the stock of Zomato were that the Indian food delivery market is expected to grow exponentially over the long term. As Indian households have more disposable income and increased online access, they may be keener to order home delivery of food more often. In such cases, a simplistic way to gauge the upside is to compare with the per capita consumption in economies with similar demographics. So, in Zomato's case, most investors adjusted the size of the market for per capita income and digital reach. And when this comparison was made relative to the Chinese market, they derived the conclusion that a market leader like Zomato has huge upside, especially with the increase in the value of the per capita food delivery over decades. But growth in the overall market is not enough to ensure reasonable certainty of growth for the company. So, what are the other elements that offer cues for such disruptive businesses? There are three of them. Let's take them one by one. Share of revenues. Does the company fetch a majority of its revenues from the core business? For instance, in Zomato's case, was the advertising revenue the bigger contributor or was it food delivery? In the case of EV companies, most large EV producers in India are yet to see a significant contribution from EV sales. The EV component companies could, however, see electric vehicles becoming a bigger share of pie much sooner. Scope of profitability. For Zomato, it meant whether the company was making profits per unit of food delivery, and if not, how long before it gets there. For the EV producers, keeping the battery cost low will be critical for profitability. Scale of reinvestment. Now, here's a big differentiation. While disruptive intermediary businesses like Zomato need relatively little capital by way of plant, equipment, or machinery, an electric vehicle producer and component maker will need significant capex in the initial years. That apart, the company will need investments in technology to keep up with competition and drive future growth. So, such scale of reinvestment will need some deep pockets. Now, let's assume based on this forward analysis, we have reasonable certainty about the upside in a disruptive business like electric vehicles. But what about the downside risk? Because we are in a completely uncharted territory, you need to have some safety nets, don't you? For only if the company has a safety net can it sustain long enough to create the value that never really existed earlier. But here too, the traditional approach won't work. Think about investing in Google or Amazon in the mid 2000s. Would you have found comfort in their financials and valuations? Unlikely. Therefore, here is a safety net I am looking for in electric vehicle stocks. When I say safe, I mean sustainability, that is S, adaptability, that is A, financial strength of the parent company, which is F, and economic viability of the product, which is E. Why are these the safety nets? When a company like say Hero MotoCorp invests in an EV startup, we know that the management of Hero MotoCorp has sufficient experience to gauge the sustainability of the EV business. So in this case, Hero MotoCorp's investment in EV startup Ather Energy brings in some degree of comfort. Adaptability. Now, a battery producer like Exide has had to contend with changing technologies in internal combustion vehicles for years. The company is therefore quite adaptable to new technologies when it comes to battery making and is ideally suited to test new variants of batteries for its customers, the EV producers. Financial strength of the parent company. Remember, I talked about heavy capex and deep pockets? Well, investing in a startup EV producer with no financial backing is fraught with risk for exactly this reason. Without the financial support from a sound parent company, the EV producers could soon run out of funds for technical investments. Finally, most important is the economic viability of the product. EVs will have to constantly compete with internal combustion vehicles on cost. So, without an economically viable product, the car or the component, the companies will find it difficult to find buyers. And not just the EV producers, even the companies that are part of the ecosystem, like say Tata Power that is setting up the EV charging infrastructure, needs to be extremely cost competitive to fetch economies of scale. So once you have these safety nets in place, valuing an EV stock, be it a direct play or a company that offers a backdoor entry into the EV opportunity, becomes much easier. So I'm sure by now you have understood that the biggest opportunity in electric vehicles is not where everyone is looking. It is hidden somewhere else. If you want to know it all, then join me at my upcoming special event on the 25th of October at sharp 5 pm. And please don't invest a single rupee in EV stocks before studying what we are going to reveal at this event. You can book your free seat by clicking on the link in the description below. Our new research uncovers some shocking truths behind today's hottest investment opportunity, electric vehicles. Don't invest your money in EV stocks before seeing our research. Click here to sign up for our special event to know it all for free.